Good morning. Welcome everybody to today's Forex trading strategy session. My name is Wayne McDonald. I'm the Chief FX Strategist for TradersWay.com. Welcome to the live webinar. Today is Thursday, January 8th, 2015. Let's get this party started. All right, let me remind you that trading and investing is risky business, not appropriate for everyone. Never trade money you cannot afford to lose. I'm going to share with you generally accepted trading techniques developed by market participants over days, weeks, months, years, decades, and centuries of trading. Both technical and fundamental analysis will be used. That past performance does not predict future results. Stay small, stay humble, focus on the long term. Never risk money you cannot afford to lose. All right, let's take a look at stuff, what's going on. You know, I'm wondering on oil here, since oil's been, moving all the markets around. I'm wondering if we're closer to a bottom. So recently we had discussed, what was it? Somewhere between 42 and 45 was the likely bottom. Well, we're getting close to that now, right? We broke through 50, then it went to 49, then it went to 48, then it's to 47. But what's interesting about 47? You guys see anything interesting? Where's our bottom? Right? Oops. How about that? Just happens to be a monthly support pivot point. It's an S1. It's only moderately important, but it's a monthly pivot. And do you agree that it seems like market participants responded to that pivot point? Like that's 47, right? It was actually 46.93. We only wicked through it briefly, right? And you say, well, Wayne, it's probably just the psychological level, right? And I say, yeah, you know what? I can't discount that. But how did it respond to 48? Right? Or 49? Or 50? Right? Or 51? Look at this one. Seems to me it was the pivot point. We talked about this, professional traders that use algorithms, right? Whether it's a high frequency trading system or whatnot. It's not, it's not hard to input pivot point calculations into a computer, right? So you can see, at least it says to me, sophisticated market participants are using pivot points. So should you be cognizant of that? Should you possibly respect pivot point levels when you get into them? Remember, it's not just a pivot point, it's a support pivot point. The first one, so far it's the only one this month we've hit. And it seems to me it's been respected by market participants. So that's good. So maybe you should use some pivot points. It's just a thought, right? Just a thought. So are we heading into the bottom? Well, I wouldn't say that yet. Support 2 is more important, and that's how we yesterday or the day before we were talking about the target being down in here, and I think there was a fib too, right? Wasn't there a fib extension down here? So anyways, somewhere around here is, here's S2. The lower one is S2. That would be the hardcore target. That puts us at 41 and some change. So let's just call it, aggressive bottom 42, conservative bottom 44, psychological bottom 45, maybe. Right? So maybe we need to watch this, maybe just a little three-wave correction, and then we start heading down. We've been doing this on currency markets recently, where these weekly pivot points We've broken through support and they become resistance. So I want to keep an eye on that, because if oil stabilizes and, dare I say, reverse, that could have an impact on a lot of different markets, both commodities and currencies, and maybe even indices. Who knows? And then if that's the case, maybe we have some trading opportunities based on. What do you stink? Smell like a plan? Me. All right. What else going on? Any gold bugs out there? Daniel, yeah? Okay. This is how we had it marked up earlier this week. Very topish. Okay. If you hit your weekly target early in the week, the thought is maybe we come back by the end of the week and touch the central pivot point. Okay, fine. Remember, we discussed, even though this failed, if you were a bull, that was a guy off of the gray zone, which is simply roll reversal and pull back to the 21. But then it fails. That's where things now become, based on price action, technically bearish. So then we discussed, I think it was yesterday, use a gray area as resistance to have it step down. If you may recall, we talked about, if the 21 breaks, we step down to the 55, right? So here's the 21. This breaks, you step down to the 55. We discussed, if you're kicking off at the 55, that you're vulnerable to a double top or lower high. Does everyone remember this? Remember, it's not my opinion, it's just the technical analysis. Like a concert pianist. I didn't write the music, but those are the notes on my sheet paper, so I can play it, right? It's just what's there. If the 55 is in control, you're vulnerable to either a lower high or a double top. Okay? So now that looks like we're getting through the 55, the next stop is the 200, which to me appears to be $1,200. Okay? Okay? Debeest asks, is it still correcting for an eventual downfall? Well, look, fundamentally, I still think the world is more interested in yield. So gold, to me, is not a logical play unless you're in it on the short term and you're just taking advantage of moves. Okay, that's fine. But fundamentally, the world is much more interested in yield. Okay? Why? Because traditionally, gold is used as an inflation hedge, but we don't have inflation. None. Half the economies in the world can't even create inflation, yet alone have to worry about it, right? I don't know, whatever. I mean, just, to hedge the dollar, why? The dollar is the strongest currency pair on the planet, or currency on the planet. So there's, the traditional reasons for holding it are just not there. And then, of course, why wouldn't you want to hold it? Well, it doesn't pay you yield. And then if you have physical gold, right, then there's a carrying charge, because you can't put it on, you're not putting it under your mattress, right? So you got to pay some guy with a vault, security cameras and everything. So anyways, technically, down here is kind of what it looks like to me. But 4 hour, Debeest wants to know about, is this a reversal? Well, technically not yet. Okay? On the 4 hour, it should come down a little more and then start heading up. So like I said, maybe down to 1200. It's a psych level, and there is a pivot and stuff in there. Okay? and the 200 EMA on, I think it was the hourly chart. And now on the 4-hour chart, we get a complete Stokes cycle. So maybe it goes up. And if it's a reversal to be a stud, then this is going to come down in a day or two because it's a 4-hour chart. And you would have a lower high, lower low scenario, and that would be price action down to the next level of key support, which to me just roughing it, eyeballing it, kind of down here. So bounce at 1200 up to, I don't know, 1220 to, I don't know, 1190 up to 12 down to 1175 to 1150. Over the course of, I don't know, a week, maybe? What do you think? Remember, guys, feel free to ask questions. I'm here to help you. I'm not here to tell, I'm here to teach. So that's oil, that's gold. S&P 500 rallied yesterday. I think we covered it here, but I know I did have it laid out. Two things going on with this. Let me zoom in. Okay, one, pivot point. Two, let me change the colors here. If you take the low, you take the high, and then you take this area, it's exactly 78.6%. Why is that important? This is the S&P 500. I think we talked about it here. Okay. The 786 is a Fibonacci retracement, but it's an important one because if you go any lower than 78.6, it's not a retracement, but a reversal. And if we did that, you know, it's a long way down because it's the stock market's reversing. Not just a big old pullback, you know, oh, well, you know, it's just a 5-day drop, you know, whoa. That would have been very bad technically, okay? Now, the reason I say I think we covered it here is that I remember saying things like that there are more market participants that make money when the stock market goes up than when it goes down. So there is a prevailing wind propping stocks up. And a lot of times, you know, like a mutual fund that has done, let's say, analysis. They got like a couple of PhDs and an MBA. They all sit around doing their analysis, and they say they want to buy XYZ corporation, you know, because the management team, they like the product and the service and where they fit in the industry, and you know, their new services coming out against the competitors, and they're you know, they say, hey man, we should buy XYZ corporation, but you know, let's wait for a decline in the stock prices so that we can buy in a falling market versus buying in a rising market, right? And all of a sudden you get like a 3-day decline, and you know, the team gets together and say, all right, what's on our table, what do we want to hold, and what do we want to trim from our portfolio? So they start rebalancing. They take some money off the table on some of the winners, they cut some of their losers, so they go to cash, they have some dry powder, and they say, what do you want to buy? And they say, hey, remember XYZ Corporation? Yeah. And they just start buying because they've already done their fundamental analysis. They've already made the trading decision, they just need a discount, and they need to rebalance their portfolio. And so they do that, and you know, on day 4 or day 5 of a decline, it rallies back up. Okay, that's all good and fine and dandy and all that kind of stuff, but if you drop below a 786, it's not a retracement, it's not an opportunity to buy, it's an opportunity to go to cash, right? Move to the sideline, buy a bunch of bonds. So that's why I watch things like the 10-year T-note. right? 2-year, 5-year spread, stuff like that, to tell me, is this a retracement or a reversal? And my response as a currency trader or even as a commodities trader, right, is to, recognize what's happening in the market and make adjustments. Okay, if the stock market's retracing, it's a good opportunity to buy. If it's reversing, it's a good opportunity to certainly not buy, right? Not buy soon, anyways, until we get a reversal. So, anyways, it tells me a lot of different things. So that was a key. That was key. That was very, 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 very key. Okay. Check this out. You notice how we're at a pivot cluster? So what if the stock market opened down and then rallied back up tomorrow after non-farm payrolls? Not too good, but good. Okay? What did we learn from FOMC yesterday? We're chugging along at the proper pace. The Fed's happy with what's going on. But here's the thing. They're patient. They're not eager to raise interest rates. Good. The economy is good, thumbs up, so that's good for the stock market. And they're not going to raise interest rates soon. They're going to be patient. They're not eager. Right? They have the card, but it's not on the table. Two thumbs up. Let me put it this way. How would you like some free money and continue to get free money for the near term? You're like, yeah, sounds good. That's why the stock market goes up. But, I call quantitative easing a free money rally. I don't know. Watch the European stock market. If the Fed officially announces real quantitative easing, watch the European stock market. Might be some opportunities there. So how about now? Let's flip over to euro and let's talk about the euro. Did you guys watch the PPI today? Eurozone PPI? It's inflation, right? You guys know the difference between CPI and PPI? CPI is the consumer stuff. That's prices going on the computer side. PPI is inflation on the producer side. So costs of things to make, costs of widgets and gadgets, and you put them together and you make a product and then you sell it. But the thing is, there's only a certain amount of elasticity in prices when it comes to, selling to the consumer because they have choice and they say, well, I'm looking at your product and that product. And so competition keeps prices stable and low. So producers and sellers have to make decisions on, if the cost of the product goes up, do they raise prices and be less competitive, or do they just make less profit? And so that's why you want to look at PPI and CPI. Commodities have been coming down hard, haven't they? And what we've seen here in Eurozone PPI is a negative number, both month over month and year over year. Not good. Not good for Europe, who's worried about deflation, right? They have high unemployment, low CPI, right? Negative CPI, negative PPI. See, here's the thing. If you see inflation going up on PPI, you're going to see it first, and eventually there won't be any profit margin left. So therefore, the sellers will actually have to raise prices, and then you get CPI inflation. And when you have CPI inflation, the consumer price index inflation, which is a basket of goods and services offered to consumers, then the central bank, in this case the ECB, since we're talking about Europe, would have to raise interest rates. Or if they're in quantitative easing, stop quantitative easing because they see inflation. Well, we're a million miles away from that. Okay? And so a negative number and a big negative number, negative 0.3% month over month, like it's worse than last month, and last month was horrible, and it's worse, and then more worse than expected. I mean, double negative, right? So anyways, bad for euro. Okay, why? Because the way out is quantitative easing. Quantitative easing devalues the currency. It's an increase in supply, right? Right? Supply and demand curve. If supply goes up, the value goes down. So they print money and buy bonds with it. Therefore, inserting the money into the economy. But more of a thing. You guys remember the story about Germany after World War II? The Bundesbank printed so much money that the value of your Deutschmark would drop by 50% every single day. And there's a picture somewhere, or at least a story I've heard a million times, about a man going to the bakery to buy a loaf of bread, and he has a wheelbarrow full of Deutschmarks to buy one loaf of bread. Because the bank would just print money. Hey, we need something. We'll print the money. Problem with the fiat currency, huh? So, anyways, I'm going down in the burning ring of fire. So let's take a look at these swings. Okay, like I've been teaching you, you notice we get a low lower than this low. Drag it over. Should be future resistance. Okay, comes along, makes a new lower low. Grab it, make future resistance. Right. Good. Now we're down here, made a new lower low, drag this over, this is future resistance. Okay, and the way that you should be eyeballing this is like that. Okay? Trying to get you to think ahead. You guys like that? That's called price action. Because there I'm not even really paying attention to the moving averages. I don't have any pivot points. That's just price action. Right? Previous support becomes future resistance. Previous support becomes future resistance. Previous support, right, becomes future resistance. Previous support becomes future resistance. Until it reverses. And you're like, well, Wayne, how do I know it reversed? Because it does this. And then even then you got to change your fractal. You understand fractal geometry? So that's just one time frame that we're looking at. Excuse me. That's just one time frame we're looking at, and it's a small time frame. That's just a 5-minute chart. Right? But let's say you change it to an hourly chart, their trade plan looks like this. Because that's all they see. They don't see all these tiny little candles, right? The candle just kind of goes up and down compared to yours. So they're just saying, hey, let's catch a 50% Fibonacci retracement or something simple like that, and that would be about here, right? British pound. Let's back this a little bit. Again, a 5-minute chart, right? So what are you thinking here? Are you going to do the price action play? Okay. You see, it's just a 5-minute chart. Take a look at a higher fractal. We can go to an hourly now. Now you can see why I say you shouldn't stand in front of a freight train. Remember that discussion earlier in the week? It can and probably will fall further. Don't stand in front. Don't bet against it. The only hope, technically, is if it reversed at the weekly pivots. Okay, then I would be into it. But it hasn't even done that. So you're going to have to rely on monthly pivots. Wait, those were monthly pivots? Oh, wow. Oh, snap. Yeah. Well, you know what? Getting punished. It's funny, 8 months ago, we thought the Bank of England was going to raise interest rates, and then it all fell apart. Here's the 50-50 mark. Okay, again, on a 5-minute chart, seems to me a trend trader would have this fibbed up. Either here, probably more like the higher fractal, right? At the bare minimum. So, you got your sweet spot here for shorting. There is some price action here. That would be trade plan number, kind of in this area. Trade plan number 2 is you got the 786 reversal, psychological level of 51,000, and just above that you have the daily central pivot point and I think a Fibonacci retracement of yesterday's trading range, so that'd be about a 382, I think. So 2 trade plans in play here. If you're a bear, sell it off the 50 to 60. So well, yeah, I guess 50, 80. The next one would be around 51. Okay. Cry all night to get back home tonight. All right. Lufle tuliumum. Don't you just love trading? It's funny how I still look at charts and I get all tingly inside. Change fractal. 15-minute tried to come down, is having trouble. Around a 15-minute 55. Okay, so that means we could get a lower high. So let's channel trade it then. Let's change it slightly. What I'm thinking now is it's going to work its way up to 51 or so, like this, and like this. Because the 15-minute oscillator wants to come down, or is diverging, if you guys use divergence, right? So it kind of feels like this, that the 55 on top of us suggests a lower high, or sorry, a higher low. So let's say drops down to 50-50, okay, and then up. Or it kind of almost feels like double bottom up and then down. So keep an eye on that. 15-minute chart's interesting. Okay, but the 55 tells us, though, at best you should expect a double bottom, but perhaps a lower high. So, or sorry, a higher low. Okay, that's what the 55's telling me. And that is a 50% retracement as well. Okay, so the market's still technically bearish. It's just less bearish than it was before. Okay, so again, maybe, a big old Elliott wave correction type thing. If you're an E wave guy. So like here's the thing, guys. if you're decide whether you're a bear or not. And if you're a bear, identify 2 levels of resistance and get ready to sell. Don't worry about running all around in circles, right? Okay. Any requests for currency pairs? I think we had some yens, requests for yens. Voon, Trevor, Pete, Peng, Jim, Dan. There's only one DBista. Bobby, Ace, what do you guys want? Let me help you. Okay, I'm good with that. Request for Looney, since we talked about maybe a potential bottom on oil. You know, like I said, maybe a potential. We're not quite there. I think it can go lower, but there is more and more support down there. Okay. Again, I'm on a 5-minute chart. How many people remember the swing trading lesson I gave earlier? I don't know if it was this week or last week, but it was recent. Let's go over it again. One way that I like swing trade, this is particularly, it's called an Asian fade trade. And what I look at is the previous day's high, the previous day's low, and like a pivot point, very often I look at the close. Where did the market close? So in this case, it closed low. I consider that market sentiment. Market closed low at the end of the day. Well, it can't be a bullish market, can it? Probably not. Okay? So there's more chance for a downside, in my humble opinion. So high, low, and close. Okay, so I'm a bear on the low close. On this currency pair, right? Because that's where it closed. All right, so now my sweet spot for selling, let me change colors here just because we have the pivots up there. The sweet spot is somewhere between the 382, 50%, and 618 Fibonacci retracement in yesterday's trading range. Okay, again, I'm looking at the low and the high. And so all you, right, here's the high, here's the low. So all I'm looking at is 382, 50%, 618. Together, that's what I call my sweet spot. And somewhere in there, I would like to sell. If I'm a bear and the low close tells me it might be a bearish market, or at least sentiment. So this is the trade plan. Very often you could use like a limit order or a binary option and say, I want to be short up in here. And your stop is how many pips away? 50, let's say, typical kind of spot trade or something like that. All right, so let's say you just sell at the 382. Like when you're down here, you put a limit order and you say, all right, the 382 here, so if we touch that, just sell it. That's around 35, right? So 85 would be your stop, and 85 is not even on the chart. It's so high. In fact, it's higher than yesterday's high. So is that more than reasonable as a stop? Yeah, it seems like, it seems like if we're making a daily higher high, you'd really want to be a bear, right? So anyways, you can manage your risk the way you see fit. But you can see in this case it hit it exactly with a nice central pivot point as a kicker and dropped from 35 down to, what is that, 95. So a big whopping 40 pips or something. Likelihood that you took them all pretty low, but you certainly would have got a 25 pip scalp, right? And you might have said up here 50 pips is too big, so maybe you throw down a 25-25 OCO. Or like I said, a binary, right? And a binary is basically like what, roughly a 25-20. So you're like, but where's those other 5 pips? Well, if you traded currencies, your 25-25 OCO has the spread built in, so it probably is still a 25-22 OCO depending on the currency pair, right? So it's not perfectly balanced, a 1-to-1 risk-reward ratio, right? And then of course, so what do you get for the extra 2 pips? You get the, you get to throw away volatility out of the, because this could spike up 25 pips, knock you out, and then go down, where that can't happen on a binary. So to each his own. In that case, you could do it, especially if you're in a range-bound market. I'd probably rather throw down a binary at resistance because I'm not expecting it to trend. But if I'm expecting it to trend, like if I thought this was going to fall 150 pips, then I wouldn't do a binary. Not for the profit side. If I did a binary, I'd probably short the cash and then use a binary to hedge. And then I'd jam my stop in here and off we go, right? Okay, makes sense? So that's kitty CAD. If you want the Canadian dollar to gain strength, then you're kind of looking in here, right? It's gone a little higher than, but I don't know. It's not that bad. It's only 20 pips, right? So the other way of doing it is maybe you fib the sucker. Currently, our top is exactly 618 fib. So, what you'd hope for if you're a bull of the Canadian dollar, which means oil prices going up, then you're probably in your sell zone right now. Okay. Check it out on a 15-minute chart. Yeah, it looks like a nice little roll reversal to me. Right? I'm just looking at this area. Oops. Just kind of looking at that area, right? Seems like a reasonable place to short. It's not quite ready oscillator-wise, but it's setting up. Hourly basis, if you're a bull, this 18 is where you bought it. That's already happened. And if we break that, the next one's way down here, right? So based on the correlation, that it's all possible, but I want to go back to oil and I want to point it out so we're all on the same clue train. I'm not calling a bottom. In fact, the support, monthly support 1, it's respected here, but it's not a huge deal. We're getting there though. Okay? So I think what we talked about yesterday or the day before that, I don't know, was it was more of a 45 to 42 area, right? Really, it was more like 44 to 41, but let's just put it this way, right? How about somewhere between 45 and 40, right? And closer to 40, and I think it was 41. There's like pivots and Sykes. There's just all the support, and so that would be a really high potential for a reversal. We're not there yet. But we're getting close, and the news to use here is that market participants, the biggest oil traders in the world, are still respecting pivot points dramatically, not weekly, monthly. So the next one to keep your radar screen is the monthly support 2. We're at monthly support 1. And to me, the one I respect the most is MS2. And that's at like 41 and some change. So if they respected MS1, then how about MS2? Okay? So I think it could do this, 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 and then I would really look for reversals. But it could do it now. It could. Why not? It could. So play it close. Manage your risk. Okay? And if or when this commodity rebounds to the upside and goes from retracements to reversals, then the Canadian dollar could benefit greatly. Okay? But look at that pivot point. How about that? Next time it hits there, maybe, right? Maybe it's binary time. Okay, let's take a look at the overall yens. No, Jim, one of the parts of the swing trade is I call it an Asia fade, right? Because it's basically at the Asia close. It fades and then you drop it before London, and London carries it. Okay? But New York, all bets are off. So what I've said for the last 10 years is you can get lucky in London because it's a big amount of money all coming into the market at the same time. And you could really figure out the London boys easy because guess what? Here's how they trade. They sell high and they buy low. I know, shocking, right? Shocking. But if Asia takes it up, then London's going to push it down because they sell high. I mean, come on. You don't have to be a rocket surgeon, right? If Asia takes it down, the London boys are going to buy it up because they're going to buy it cheap. Right? That's what they do. So you can get lucky and just kind of like get one trade in there, throw it down, let it run all the way through London, and pick up some pretty good pips because you're riding the wave. I call it Asia fade. You fade the London, or you fade the Asia move pre-London and let the London boys carry you. New York is like a street fight. You're not going to get lucky in New York too often. And if you do get lucky, it's probably unlucky because there's a lot going on. It's the reserve currency of the world, massive commodity market movement, massive bond market movement, massive option movement, massive moves on the S&P 500, central banks, news. It's up, down, turning around, right? So you better be on, better have your wits about you. Better have a trade plan. Okay. Let's just, what was kind to me yesterday and this morning was being long Aussie yen specifically. So that's paid off really well. Right in here would have been the short zone, right? If you were a bear, that'd be a short zone, right? Here, 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 and it didn't fall. What does that mean to you? Retracement or reversal? Well, on this time frame, it's feeling awfully bullish. Next area of concern for a bull would be here. Oh, that's actually where we are. Pretty close, right? It's a weekly M2, 97, let's just call it 97.50, previous price action. And then just above that, 97.70 is a weak pivot point. Okay. So maybe does this for now. Okay. Yeah. Interesting stuff, huh? Let's just quickly look at another one. Euro coming down like a ton of bricks. But I'm not interested if the yen, if we got risk on and the yen is actually relatively kind of a little bit weak, I don't want euro yen because the euro is fleas, right? So I don't want to buy euro, and nor do I, so it's just the wrong pair. Kiwi maybe. We've been talking about Kiwi a lot, right? Because it might be your opportunity to get into a higher risk trade. Do you guys remember the example? And I think it was this one. No, it might have been USD yen. Yeah, where you use a binary to hedge the downside, and you go long cash and you short the derivative, right? The hedge. That might have been a good opportunity here. Also, as we talked about on many currency pairs, if it reverses early in the week, right? These are weekly pivots, the red at the top, the green at the bottom. If you hit your targets early in the week, like a Monday or a Tuesday, very often by the end of the week you hit the central pivot point. This is the weekly central. So this one did it. Okay. This one did it. Right now we've pulled back on this on the 15-minute chart. So to me it looks like it's going to double top around 93.5, maybe reload, and then work our way up to the target. Okay. We're at weekly resistance. Right here, that's the weekly R1. And just above that, a weekly pivot. And just below that, cycle. A lot going on, but there's the move. Okay, very, very interesting, isn't it? All right, well, be careful. Trading and volatility could dry up very quickly today. Tomorrow is non-farm payrolls. You'll see me at fxstreet.com. I think it's what, the 104th month in a row I've traded non-farm payrolls live. 104 months. I bet you've never met a currency trader that's traded that long, especially live in front of hundreds and hundreds and hundreds of people. Huh? Very interesting. So I won't be here tomorrow, right? These strategy sessions will be from Mondays, Tuesdays, Wednesdays, and Thursdays. So if I don't see you at fxstreet.com, then I will see you here Monday morning. And on Mondays, I like to go through the routine of checking commitment of traders report. And I like to review the calendar to get my head screwed on straight for the rest of the week. And like I said earlier in the week, we had a lot of British pound. We had a lot of CAD toward the end of the week. I think that worked out pretty well, don't you think, as far as using the news to predict volatility? Remember I said start the week with pound and end it with CAD? Well, it's been good. I'm glad to see the yen weakening again. Right? So anyways, like I said, if I don't see you at FX Street, I'll see you here for a strategy session on Monday. Peace on earth. May the pips be with you. May your profits be above average. Thank you to Traders Way. Cheers.